I want you to smile. Yes, smile. Because what you are seeing right now is not a market crash. It is not a liquidation of physical metal. It is the most obvious, desperate, and clumsy attempt at market manipulation I have seen in 20 years of trading. It is a bear trap of historic proportions. Ladies and gentlemen, Asian guy here, known as John A.G. from Currency Archive. If you are looking at that chart and feeling fear, you are playing their game. You are reacting exactly how the algorithms want you to react. They want you to look at the price of 16,867 yuan and think, the rally is over. The squeeze has failed. I need to sell. But I am here to tell you that the rally hasn't even started. This red candle is not a signal to sell. It is a signal that the banks are terrified. Let's call this what it actually is. In the old days, on the floor of the exchange, we called it painting the tape. Today, in the digital age, we call it spoofing. It works like this. The bullion banks, the same entities we know are naked, short millions of ounces, wait for a moment of maximum weakness. They wait for a holiday weekend. They wait for a time when the volume is thin, when the industrial buyers in Shenzhen are asleep or away for the new year, and when the Western traders are hungover. And then, in the vacuum of liquidity, they unleash a massive wave of paper sell orders. They dump thousands of futures contracts onto the market in a fraction of a second. These contracts do not represent real silver. They do not represent bars sitting in a vault that are being sold by a miner. They represent nothing. They are digital promises, paper silver, created out of thin air by a desk trader at JP, Morgan or Citigroup. They flood the order book with this fake supply to smash the price down vertically. Why? Because they are trying to trigger your stop loss. They know that thousands of retail traders bought the breakout. They know exactly where your stop orders are sitting. By pushing the price down artificially, they trigger those automatic sell orders. Your computer sells your position to stop the pain, and who is on the other side buying it? The banks. They smash the price to force you to sell, and then they scoop up your contracts at the bottom to cover their own naked shorts. It is a transfer of wealth from the impatient to the manipulative. You have to remember the core argument we have been making for years, the John Agg argument, the fundamental thesis of this entire movement. The banks are short. They have sold more silver than exists in the entire world. We know that for every ounce of physical silver in the COMEX vaults, there are likely 100 to 300 ounces of paper claims trading against it. This is the fractional reserve scam of the precious metals market. So, when you see the price drop like this, it is not because there is suddenly too much silver. It is because the banks are frantically trying to reduce that ratio. They are trying to shake you out of the market so they can close their short positions before the real physical shortage hits. Think about the timing of this smash. It is Saturday, January 3rd, 2026. The China export ban went live exactly 48 hours ago. Does it make any logical sense that the price of silver would crash after the world's largest producer banned exports? Does it make sense that the price would drop when the supply has just been cut off? No. In a free market, the price would have gaped up to $30 or $40 instantly. The fact that it went down proves that this is not a free market. It proves that there is a non-economic actor interfering with the price discovery mechanism. The price action is effectively lying to you. The banks are trying to paint a picture of weakness because they know the reality is terrifyingly bullish. They are looking at their internal ledgers. They see the withdrawal requests piling up. They see the loadout notices from the vaults. They know they don't have the metal to deliver. So their only option, their only survival strategy, is to smash the paper price to discourage you from taking delivery. They want to make silver look like a bad investment, so you will go away and buy Bitcoin or Nvidia stocks. They're trying to bore you into submission. They are trying to scare you into submission. But look at the volume on that drop. Look closely at the chart I showed you. The volume spike happened in minutes. Real selling, commercial selling, takes days or weeks. A miner selling their production sells slowly to get the best average price. Only a manipulator sells everything at once to get the worst possible price. Why would a seller want to crash the price of their own asset? They wouldn't. Unless they're short. Unless they make money when the price goes down. This is the smoking gun. The entities selling silver today do not own silver, they owe silver, and they are trying to discount the debt they owe by devaluing the currency of that debt. It is a desperate, flailing attempt to hold back the tide. But the tide is coming in, whether they like it or not. And you have to ask yourself, if the price is crashing, why can't you buy physical metal at this price? Go to your local dealer right now. Go to the online bullion sites. Try to buy a silver eagle for the spot price implied by this crash. You can't. The premiums are still sky high. The inventory is still sold out. This confirms that the crash is happening only in the paper matrix, not in the real world. In the real world, the price is holding firm. In the real world, nobody is selling their physical stack because of a red candle on a screen in Shanghai. The weak hands are being flushed, yes. The leveraged speculators are being wiped out. But the strong hands, the people who understand the manipulation, are not moving. We are watching the show. We are eating popcorn. Because we know that every time they smash the price, they are digging their own grave a little deeper. They are making silver cheaper for the very people who threaten them the most. And who are those people? Who are the entities waiting in the wings, ready to swallow up this cheap silver? It isn't just you and me. It is the industrial giants. It is the sovereign nations. They are looking at this price drop and salivating. The banks think they are saving themselves, but they are actually creating the opportunity of a lifetime for the industrial complex. Because while the bankers are playing games with algorithms, the world has fundamentally changed outside their windows. The geopolitical landscape has shifted beneath their feet. And there is a new player on the field, a player that doesn't care about COMEX margins or London fixes, a player that has been demonized, sanctioned, and isolated but holds the key to the energy market. We need to talk about the floor that is forming under this market. We need to talk about the news coming out of Caracas. Because while New York smashes the price, Venezuela is building a bridge that bypasses the dollar entirely. And that bridge is built on a foundation of yuan, not dollars. We have received intelligence confirming that the Venezuelan state oil company is accelerating its transition away from the US dollar for its energy exports to China. They are effectively settling the oil trade in the Chinese currency, bypassing the Western banking system entirely. You have to understand the magnitude of this shift. For 50 years, since the mid-1970s, the entire global financial system has rested on one pillar, the petrodollar. The deal was simple. The world buys oil in dollars, which creates an artificial, permanent demand for the US currency. It allowed the Federal Reserve to print money without consequence because the world had to hold dollars to buy energy. But today, that pillar is crumbling. Venezuela sits on the largest proven oil reserves on the planet. China is the largest oil importer on the planet. And now, these two giants are trading the world's most critical commodity without touching a single US dollar. This is the nightmare scenario for the Western banking cartel. Because when you remove the demand for dollars in the energy trade, those dollars have to go somewhere else. They come home. They flood back into the domestic economy, creating inflation that the Fed cannot control. And what is the historic hedge against a dying currency? What is the one asset that has preserved purchasing power for 5,000 years while paper empires burn? Silver. So, when you see the banks smashing the silver price to $73, realize what they are doing. They are trying to suppress the burglar alarm while the house is on fire. They are fighting a geopolitical tidal wave with a paper spoon. The alliance between Venezuela, China, and Russia is effectively putting a hard floor under commodity prices. Think about it from their perspective. The East, the BRICS nations, are the producers of commodities. They produce the oil, the grain, the copper, and the silver. The West is the consumer of commodities. Do you think China and Venezuela want low commodity prices? No, they want high prices. They want to get paid more for their assets. They want to drain the wealth of the West by forcing us to pay true value for the resources we consume. This is why the $73 price on your screen is a lie. It is a price set by the consumer, the West, trying to pretend inflation isn't happening. But the producer, the East, is building a new system where that price is irrelevant. If Venezuela sells oil for yuan, and China uses that yuan to buy silver from its own mines, the US dollar price of silver becomes a meaningless number. The arbitrage we talked about earlier isn't just about price differences between cities, it is about value differences between civilizations. And this creates a floor that the banks cannot break. Every time they smash the price down, they are effectively putting silver on sale for the very nations that are trying to dethrone the dollar. Do you think the People's Bank of China is worried about a red candle on the chart? No. They are thanking J.P. Morgan for the discount. They are taking those surplus dollars they no longer need for oil and converting them into hard metal at suppressed prices. The banks are subsidizing their own destruction. This Venezuela connection is the macro support that prevents silver from going to zero. In a normal market, if the price crashes, buyers might get scared and walk away. But in this market, the buyers are strategic. They are ideological. They are buying silver not to make a 10% profit, but to insulate themselves from the collapse of the Western fiat system. So the lower the price goes, the faster the physical metal disappears into the vaults of the East. It creates a paradox. The more the banks smash the paper price, the more physical stress they create in the system. And this brings us to the mechanism of the squeeze. We have the motive, the banks are short. We have the macro floor, the death of the petrodollar. But we also have a specific tactical weapon that was deployed exactly 48 hours ago to tighten the noose. We have the anaconda squeeze. While the banks are distracted trying to manipulate the chart, the Chinese government has quietly activated the most restrictive export controls in history. They have wrapped a regulatory snake around the supply chain, and it has just started to squeeze. Let's look at the ban. Let's look at why the supply of physical silver available to the West just dropped to zero, regardless of what the fake price says. And this squeeze is not a sudden violent explosion like a bomb going off. If it were, the banks would know how to handle it. They would just halt trading, declare force majeure, and reset the board. No, what we are witnessing is something much more dangerous, something much harder to fight. We are witnessing the anaconda strategy. Think about how an anaconda kills its prey. It doesn't strike once and leave. It wraps itself around the victim's chest. Every time the victim exhales, the snake tightens its grip just a fraction of an inch. It doesn't crush the bones immediately. It simply prevents the victim from taking the next breath. It is a slow, methodical, and inevitable suffocation. That is exactly what the January 1st export ban is doing to the Western silver market. As of 48 hours ago, the new Ministry of Commerce regulations in Beijing are active. The free trade era of silver is over. In the past, if Apple or Tesla needed 10 million ounces of silver, they could just pick up the phone and order it from a refinery in Jiangxi or Henan. The metal would be on a boat in 3 days. It was seamless. It was invisible. But today, that phone line is dead. The new rules require a specific government-approved export license for every single shipment of dual-use strategic metals. And dual use now includes high-purity silver because it is essential for both military guidance systems and the energy transition. Do you think the Chinese government is handing out these licenses like candy? Do you think they are going to approve a shipment to the United States, their geopolitical rival, just because the COMEX price is $73? No, the licenses are being denied, or they are being delayed for administrative review. This effectively cuts the supply line. The artery that feeds the Western industrial machine has been clamped shut. But here is the trick, and this is why the price didn't explode yesterday. The West hasn't suffocated yet. Just like the prey and the anaconda's grip, the West still has some air in its lungs. There is still some inventory sitting in the warehouses in London. There is still some metal in the pipeline that was shipped in December. So, the factories are still running. The panic hasn't hit the assembly line yet. The banks are using this temporary pocket of air to smash the paper price. They are pointing to the fact that the factories are still open and saying, "See, no shortage. The ban is a nothing burger. Sell your silver." But this is the ultimate deception, because the air in the lungs is finite. The pipeline is emptying. The ships that arrived in December are the last ships coming. Once that inventory is consumed, which will happen in weeks, not months, the next breath simply won't be there. And that is when the panic begins. That is when the anaconda tightens. You have to look at the divergence between the paper signal and the physical reality. The paper signal, the red candle on your screen, says that silver is worth $73, down from $80. It says supply is abundant and demand is weak. But the physical reality is that the largest supplier in the world, China, has just exited the market. China refines roughly 50 to 60% of the world's silver. Imagine if Saudi Arabia announced they were stopping all oil exports tomorrow. Would the price of oil drop? Of course not. It would go to $500 a barrel. So why is silver dropping? Because the market is rigged. Because the price is being set by paper contracts that have no connection to the physical metal leaving China. But here's the fatal flaw in the bank's manipulation. The lower they push the price, the tighter the anaconda squeezes. If the price of silver was $200 an ounce, maybe, just maybe, some Chinese smugglers would try to get metal out. Maybe the Chinese government would be tempted to sell some reserves for profit. But at $73, it is an insult. It encourages the Chinese refineries to hoard even more. It tells them the West is undervaluing this asset. Keep it here. It accelerates the internal stockpiling within China. So by smashing the price, the banks are actually ensuring that zero metal leaves China. They are effectively enforcing the blockade on themselves. And while the banks are playing this dangerous game of chicken with the supply chain, the real consumers of silver, the entities that actually need the metal to exist, are watching in horror. They are not looking at the chart and thinking, sell. They are looking at the empty loading dock and thinking, survival. I'm talking about the industrial complex. I'm talking about the silent buyers who are stepping into this market right now, quietly, desperately, while the retail public gets scared out of their positions. We need to talk about the panic that is building in the boardrooms of Silicon Valley and Seoul, because while you are worried about the price dropping, Samsung is worried about the lights going out. Let's look at the industrial panic. Let's look at the tech sector. And this panic is not taking place on the trading screens of the COMEX. You won't see it in the RSI or the MACD indicators. It is happening in the hushed, soundproofed boardrooms of the world's largest technology conglomerates. It is happening in the procurement offices of Seoul, in the semiconductor fabrication plants of Taiwan, and in the gigafactories of Nevada. While the average retail investor looks at the red candle on their phone and thinks the sky is falling, The industrial titans look at that same red candle and think, thank you. Because for them, this price smash is not a signal to sell. It is a lifeline. It is the last chance to secure the physical inventory they need to keep their factories running before the anaconda we just discussed chokes off the supply completely. You have to understand the psychology of the industrial buyer. A company like Samsung or TSMC or a massive Chinese solar manufacturer does not care about the chart patterns. They do not care if silver is overbought or oversold. They care about one thing and one thing only: existence. Silver is not an investment for them. It is oxygen. Without silver, you cannot build an electric vehicle battery. Without silver, you cannot build a solar panel. Without silver, you cannot build the advanced AI chips that are currently powering the entire stock market bubble. Silver is the most conductive metal in the universe. It is the irreplaceable nervous system of the modern economy. So when the price drops to $73, do you think the procurement officer at Samsung says, "Oh, the chart looks bearish, let's wait"? No. He screams at his broker, "Buy it all. Buy everything you can find." We are witnessing a massive silent transfer of physical wealth from the weak hands, the retail speculators who are scared, to the strong hands, the industrial users who are desperate. The banks are smashing the price to shake you out so that their corporate clients can step in and vacuum up the metal at a discount. It is a classic bait and switch. They paint the tape red to make you feel like a loser for holding silver. But behind the scenes, they are facilitating massive off-market deliveries to the very companies that are driving the demand. And the urgency is real. We have reports of major electronics manufacturers shifting their inventory strategy from just-in-time to just-in-case. For 30 years, the global supply chain was built on just-in-time. You order the metal on Monday, it arrives on Tuesday, and you put it into an iPhone on Wednesday. It was efficient. It was cheap. But the China export ban has killed just-in-time. Now, if you don't have the metal sitting in your own warehouse, you're dead. So these companies are panic buying. They are trying to secure 6 months, 12 months, even 2 years of supply right now. They are front-running the shortage. And this creates a massive phantom demand that the paper market isn't showing yet. The paper market sees selling. The physical market sees hoarding. This disconnect is most visible in the solar sector. We know that the new generation of solar panels, the TOPCon and HJT cells, use 50 to 80% more silver than the old panels. We know that the solar industry alone is consuming nearly 200 million ounces a year. That is 20% of the global supply. And where are most of these panels made? China. So when China bans exports, they are effectively hoarding that silver for their own solar dominance. But what about the solar factories in Europe? What about the ones in the United States? They're cut off. They are the ones bidding up the physical price in the shadows. They are the ones calling the refiners and saying, "Name your price, we will pay it." They would happily pay $100 an ounce right now, because if they don't, their multi-billion-dollar factories turn into worthless concrete boxes. The cost of silver, even at triple digits, is a tiny fraction of the total cost of a solar project. But the cost of having no silver is total bankruptcy. This is called inelastic demand. It means the buyer will pay any price because they have no choice. And this brings us to the next phase of the crisis, the electronic shortage. We are already seeing the warning signs. The lead times for high-purity silver paste, the specific material used in electronics, are stretching out. What used to take 2 weeks to deliver is now taking 8 weeks. Soon, it will be 12 weeks. Then, indefinite backorder. When that headline hits, Apple delays iPhone production due to material shortages, or Tesla halts Cybertruck line due to silver lack, the game changes instantly. The public will suddenly realize that silver isn't just a boomer rock or a conspiracy theory metal. They will realize it is the new oil. In the 20th century, wars were fought over oil because oil powered the tanks and the factories. In the 21st century, the economy runs on electrons. And silver is the highway those electrons travel on. If you control the silver, you control the AI revolution. You control the green energy transition. This is why the $73 price is such a magnificent trap. It lulls the public to sleep right before the resource war begins. It convinces you that silver is abundant and cheap, right at the moment it is becoming rare and priceless. The banks are banking on your ignorance. They are banking on the fact that you don't know about the China ban. They are banking on the fact that you don't know about the Samsung stockpiling. They want you to look at the red candle and sell, because every ounce you sell is an ounce that ends up in an industrial vault, never to return to the market again. Once silver is turned into a Tomahawk missile or a solar panel, it is gone for decades. It is consumed. We are burning the candle at both ends. So do not be fooled by the tech wreck narrative on the charts. The tech sector isn't wrecking silver, they are devouring it. They are the silent whales swimming underneath the surface. And while the banks make noise on the surface with their paper contracts, the whales are swallowing the ocean. And this leads us to the final question. If the banks are short and the industry is buying and the supply is cut off, how does this end? How do we get from this manipulated $73 low to the triple-digit reality that the math demands? What is the strategy for the individual investor who is watching this war between the banks and the industry? Because you are not a bank and you are not Samsung. You are a guerrilla fighter in this market. You need a strategy that protects you from the volatility, but ensures you're standing there with your bucket when it starts to rain wealth. We need to talk about the diamond hands approach. We need to talk about why holding through this pain is the only way to win the ultimate prize. Let's wrap this up with the conclusion. Let's look at the strategy. They have smashed the price down 1,000 points in a single session. And now they are sitting back in their high-rise offices in Manhattan and London waiting. They are waiting for you to flinch. They are waiting for you to look at your account balance, feel that pit in your stomach, and hit the sell button. They are counting on your fear. They are betting on your weakness. They believe that the average retail investor is soft. They believe you have paper hands. And if you sell now, if you let them scare you out of your position at $73, you prove them right. You become exactly what they think you are. Prey. You become the dumb money that finances their bonuses. Because remember, every single contract you sell, they are buying. Every ounce of physical silver you liquidate in a panic, they are scooping up to cover their naked shorts. You are not cutting your losses. You're donating your wealth to the very people who rigged the game against you. So the only strategy, the only way to win a rigged game is to refuse to play by their rules. We call it diamond hands. But this isn't just a meme from a Reddit forum. It is a disciplined military-grade investment philosophy. It means you fundamentally reject the price signal the market is giving you, because you know the signal is false. It means you look at a price of $73 and you do not see loss, or you see lies, and you do not sell your truth for their lies. You have to understand what you are holding. You are not holding a lottery ticket. You are not holding a speculative crypto token that could go to zero tomorrow. You are holding silver. Element number 47 on the periodic table, the metal that reflects 95% of visible light, the metal that kills bacteria on contact, the metal that conducts electricity better than anything else in the known universe. It has been money for 5,000 years. It has survived the Roman Empire, the Spanish Empire, the British Empire, and it will survive the American Empire. Do you really think that a group of desperate bankers pressing buttons on a computer can destroy the value of silver? Do you think they can repeal the laws of physics? No, they can only distort the perception of value for a very short window of time, and that window is closing. So here's your battle plan. Here's exactly what you need to do in the coming days and weeks as this bear trap plays out. Rule number 1, ignore the spot price. Delete the app from your phone if you have to. Stop refreshing the COMEX ticker every 5 minutes. The spot price is the price of a paper contract that is settling in cash. It is the price of a ghost. It has zero relevance to the value of the physical metal in your safe. If the spot price goes to $50 tomorrow, does your ounce of silver shrink? Does it weigh less? Does it stop conducting electricity? No, it is still the same ounce. The only thing that has changed is the delusion of the paper market. Judge your wealth by ounces, not by dollars. If you have 1,000 ounces today and the price drops, you still have 1,000 ounces. And when the repricing event happens, when the anaconda finally squeezes the last breath out of the system, those 1,000 ounces will buy you the same amount of real estate, the same amount of land, the same amount of freedom, regardless of what the ticker said in January 2026. Rule number 2, watch the premiums. This is the only honest signal left. If the spot price is crashing to $73, but the dealers are still charging $85 or $90 for a physical coin, that tells you everything you need to know. It tells you that the physical market is rejecting the paper price. It tells you that the street price is holding firm. The banks can smash the paper, but they cannot force a dealer to sell you a real coin at a loss. As long as the premiums remain high, the bull market is alive. In fact, it is stronger than ever. High premiums during a price drop are the ultimate bullish divergence. It means the physical shortage is overpowering the paper manipulation. Rule number 3, do not use leverage. This is how they kill you. The banks know that if they drop the price fast enough, they can liquidate the leveraged traders. If you are trading futures contracts on margin, you are walking through a minefield. One wrong step, one flash crash, and your account is wiped out. You cannot have diamond hands if your broker force liquidates you. The only way to be unbreakable is to hold the asset outright, by physical metal, or by unleveraged, fully paid positions. If you have no debt against your silver, you have no risk of ruin. They can drop the price to $10 and you can just laugh. You can just wait. Time is on your side, not theirs. Every day they keep the price suppressed. They bleed inventory. They bleed credibility. You just have to sit there and do nothing. Doing nothing is the hardest thing to do in investing, but right now it is the most lethal weapon you have. Rule number 4, buy the blood. If you have cash on the sidelines, this crash is a gift. This is the sale you were waiting for. Remember when silver was at $80 and you wished you had bought more? Well, the manipulators just granted your wish. They just rolled back the clock. They just gave you a second chance to load the boat before the ship sails. Do not waste this crisis. Take the fake paper currency that is being printed into oblivion, the US dollar, the euro, the yen, and trade it for the hard asset that is being artificially discounted. You are effectively arbitraging the bank's stupidity. They are subsidizing your entry price. Thank them for it. We are standing at the precipice of a new world. The old world, the world of the petrodollar, the world of unlimited paper derivatives, the world where bankers control reality, is dying. You can see it in the desperation of their moves. You can see it in the clumsy vertical price smashes that defy logic. You can see it in the geopolitical revolt of the BRICS nations. They are fighting for their lives. But you are fighting for your future. And the future belongs to the things that are real. It belongs to the things that cannot be printed. It belongs to the silver. So, hold the line. Do not let them shake you out. When you look at that red candle, see it for what it is. The last gasp of a dying system. The bear trap has snapped shut. But if you're holding physical, you're not inside the trap. You're watching from the outside. And the only thing inside the trap is the banks themselves. They have trapped themselves in a short position they cannot cover, in a market that is running out of metal against a world that is waking up. The squeeze is not over. The squeeze has barely begun. The spring is being coiled tighter and tighter. And when it releases, when the Venezuela floor holds, when the China ban bites, and when the industry panic buys the last available bar, the explosion will be vertical. It will be violent. And it will be glorious. This is John A.G.A. from Currency Archive. The analysis is complete. The warning is delivered. The strategy is set. Diamond hands. I will see you on the moon. Like, subscribe and share.